Hey guys, welcome to Individual Investor. In my previous video, we spoke about the income statement. Now it is time to speak about the balance sheet in more detail, and we'll use Tesla's and Rivian's balance sheets as examples. As we saw in the intro to financial statements videos, the balance sheet shows what the company owns, assets, and what the company owes, liabilities. And if you subtract assets minus liabilities, you end up with the equity or shareholders' equity. The balance sheet provides you with a snapshot of the company's assets and liabilities at a particular moment in time, and it helps us determine the financial position of a company. When you hear someone say that a company has a strong balance sheet, what they mean is that the company is not at risk of going into administration or bankruptcy anytime soon. Assets are classified in terms of liquidity. Any asset that is liquid means that it can be turned into cash within the existing fiscal year. These are called current assets. Assets that are illiquid or that can't be turned into cash within 1 year are called non-current assets. Some examples of current assets are obviously cash, inventory that can be sold within 1 year, any accounts receivable or AR, which is money that has not yet been received for any goods or services sold, marketable securities, etc. And on the other hand, some examples of non-current assets are things like property, plant, and equipment, which are illiquid and cannot be sold within the existing fiscal year, any intangible assets like patents, trademarks, or goodwill, which is the excess price that a company pays when acquiring another business. Moving on to liabilities. Liabilities are financial obligations that are owed to external parties. This could be money in the form of interest or loans owed to creditors or banks, or bills or invoices that haven't been paid to suppliers, etc. Similar to assets, liabilities can be classified in two types: current liabilities and long-term liabilities. Current liabilities are obligations that have to be paid within the next 12 months. For example, accounts payable to suppliers or any short-term debt for loans or interest. Things like unearned or deferred revenue are also recognized as current liabilities because the products or services have not been delivered to the customers yet. And if you have liabilities that are not due within the next 12 months or the next fiscal year, then this would be considered long-term liabilities. Now, long-term liabilities are very important to monitor closely because if a company struggles to meet its long-term liabilities, then this may lead to the company becoming insolvent, which ultimately increases the risk of the company going into bankruptcy or under administration. And as a long-term investor, you would want to invest in companies that will still be around for at least another 20 to 30 years. Under long-term liabilities, you can have any sort of long-term debt like corporate bonds or long-term financial leases. Also, things like long-term deferred revenue or taxes are also considered a long-term liability. The liabilities, we can calculate the equity or the shareholders' equity. This can be done by taking the assets and subtracting the liabilities. The equity is simply the net worth or the net assets of the business. Let's look at a quick example. So in this example, let's pretend we have a super simple balance sheet with a truck, a crane, a forklift, and some debt. So if we were to sell all the assets and pay off all the liabilities, so basically we sell the truck, the forklift, and the crane, and we pay off the debt, we are basically left with 500K or an equity of $500,000. And the reason we call this equity the shareholders' equity is because the shareholders have a claim over this equity. These are basically the net assets that, in theory, the shareholders own. And this equity is also called the book value of the business because similarly, in theory, this is what the business is worth. All right, quick note here, guys. If you are enjoying this video so far, I would appreciate if you can click the like button and subscribe to my channel to support my content. Thank you very much, and let's move on, because now that we know what the assets, liabilities, and shareholders' equity are, then it is time to take a look at the balance sheet from Tesla and Rivian and navigate some of these figures ourselves. All right, guys, so here we have the 10K form for Tesla for the most recent fiscal year that ended on December 31st, 2021. All right, and now let's go to the balance sheet. Perfect. So here we have all the elements that we discussed. Okay, we have the assets, the liabilities, and the equity. Okay, and then under assets we have the current assets over here. They have their own section, and then everything outside of that would be non-current assets. Okay, and the same goes for liabilities. We have under current liabilities all the current liabilities, and then outside of that we will have the long-term liabilities. So some of the assets we can point out here. So the first one, cash and cash equivalents. So Tesla has lots of cash, $17.5 billion worth of cash. They also have some marketable securities, okay, short term. So basically they can turn these marketable securities into cash very quickly. $131 million worth of that. So all the units here, all the units are in millions, by the way. Some AR or accounts receivable, so money to be paid to Tesla. That's roughly $2 billion. They have some inventory as well, so some cars that in the inventory that they can sell to customers. That's $5.7 billion worth of already ready to go vehicles or cars. And also some prepaid expenses and other assets as well, so $1.7 billion worth of that. If we add everything up, then we get $27.1 billion worth of current assets. Okay, I will come back to the non-current assets in a second. I want to show you the current liabilities first, so that we can do a quick financial health check here. So under current liabilities we have the accounts payable. So these are, this is actually like $10 billion worth of money that they have to pay probably suppliers and other external parties. Some accrued liabilities, $5.7 billion. Deferred revenue, 1.4. Customer deposits. Okay, these are the customers that paid in advance to reserve some vehicles that have not been delivered to them yet. So almost almost $1 billion here, $925 million. And there's also some short-term debt and short-term financial leases. That's also a liability, and those are equal to $1.6 billion. So if we add all that up, then we get $19 billion, $19.7 billion worth of current liabilities. Now, one quick financial health that you can calculate is actually it's called the current ratio. Okay, and current ratio simply equals the current assets divided by the current liabilities. And ideally you want to have a current ratio of 2 or greater than 2. Okay, and this is because you want to make sure that a company, in this case Tesla, won't run into any liquidity issues in the short term. Okay, and generally speaking, a good rule of thumb is having a current ratio of 2 or more. So you can obviously tell right now that $27 billion divided by, if we calculate the if we calculate the current ratio right now, we will get roughly 1.3, 1.4. So it's not bad or too bad. Obviously, if you're in a situation where you have more current liabilities than current debt, than current assets, then it won't be good if the company runs into some financial issues, or if the market conditions turn south, because then you might run into liquidity issues. Okay, again, it's not a major red flag, but generally speaking, you want to make sure that you have twice your current assets than your current liabilities. All right, so moving on here, we have the assets, the liabilities, right? And now if we look at so we have the current assets and current liabilities. And now if we take a look at the non-current assets, here we have some stuff like some operating lease vehicles. Okay, that's $4.5 billion. The solar energy systems, okay, $5.7 billion, and some other stuff as well. Now, something to point out here is, these two things: the PPE, right, the property, plant, and equipment. Tesla has $18.8 billion. So roughly, as you can see, almost like 1/3 of the total assets is in PPE. Obviously they make cars, they manufacture vehicles, so you need the plants, the factories, the warehouses, the distribution centers, all those equipment to produce vehicles. So it makes sense that they have a lot in PPE. Something as well to note is the digital assets. Okay, let me move this out of the way. Digital assets, they have $1.2 billion worth of digital assets, and you can see that they didn't have anything the year prior. This actually is their Tesla's investment in Bitcoin. Last year they bought this amount, $1.26 billion worth of Bitcoin, so, or roughly that, and that's what they have here on their digital assets. They also have some goodwill, okay, and intangibles. Remember, intangibles, things like patents, trademarks, etc., and goodwill is excess price paid on any business acquisition. In this case, you can see that both are pretty relatively low, 257 in intangibles and $200 million in goodwill. So no red flags here. Typically, if you see a company that lists or where the goodwill plays a major role, or intangibles, where these two play a major role in the overall assets, then you might want to look into that, because some companies might overstate or inflate their assets to make the balance sheet look strong by inflating the goodwill and intangible assets. Okay. And here we have the liabilities. Okay, so we covered already the current liabilities, and here we have the long-term liabilities. So some debt and finance leases, or long-term debt and finance leases, $5 billion, and then some deferred or long-term deferred revenue and other long-term liabilities. So $2 billion and three. So we have roughly $10 billion worth of long-term debt. Okay, so it's not too bad, given that the company has $27 billion worth of current assets. So they have enough as long as they maintain enough liquidity to cover and to cover the long-term debt. And even though the long-term debt is long-term, but this ensures that over time, right, as long as the long-term debt is kept in check and doesn't increase over time, then you shouldn't run into any long-term financial issues here. All right, so we have that, and so we have the totals here. So we have total assets and we have total liabilities. Okay, so now we are in a good position to compute the equity. So for Tesla, the equity is here, and you have the breakdown over here. And here we have the total stockholders' equity, and it is $30.189 billion. Now, I was doing this calculation earlier because if you actually subtract the total assets minus the total liabilities, 30, you will see that you get $31.583 billion, which is not the same as 30, obviously 30.189. So what's happening here is that Tesla has some non-controlling interest in subsidiaries. Okay, so here you can see that they have redeemable non-controlling interest in subsidiaries. Okay, and that's $568 million. And depending on the accounting model that they're using, in the case of US GAAP, being an American company, they this is listed as a liability. Okay, and also the corresponding equity will be listed here as a separate line item. Okay, $826 million. So if we were to subtract those corresponding non-controlling interest line items from our equity calculation here, then we will arrive at the same number. The difference is not massive in this case, but let's subtract 826, and here we have it, the exact same number. Okay, $30.189 billion. And yeah, that's how you get that's how you arrive at the equity for Tesla. Okay, hope that this was clear. And let's move on to Rivian now, which has actually a pretty interesting balance sheet, as you will see. Okay, so here we have the Rivian balance sheet as well. And this document is not the 10K form, it's actually the 10Q, okay, because this company went public very recently, so they have not submitted yet a 10K form, but we have the quarterly form here, which will serve the same purpose for this exercise. So we have here the balance sheet, okay. Now in this case, they're showing the most recent one on the right hand side, okay, as of September 30th, 2021. And very similarly, okay, same format. Okay, we have the assets and then current assets over here. Okay, and then here we have the non-current assets, and for liabilities the same, current liabilities and then long-term liabilities. So if we look at Rivian, we have here $5.1 billion in cash. Okay, well, they went public very recently, so they have a good chunk of cash available. Inventory, not that much, $126 million, and some other current assets. Now, what they have mostly in current assets is just cash, so $5.3 billion in current assets. All right, and then similarly to Tesla, right, these guys manufacture vehicles, so they have some property, plant, and equipment, right, and then operating lease assets, and yeah, a good chunk of their assets goes to the property, plant, and equipment, because they need to manufacture and build these vehicles, store them, distribute them, so they need that infrastructure for that. So a good chunk of their total assets is in PPE. So with that, we have a total of $8.488 billion worth of assets. Now, in terms of liabilities, okay, they have $417 million in accounts payable, money that they owe to suppliers, some accrued liabilities as well, customer deposits. Okay, so $48 million worth of customer deposits, similar to Tesla, okay, where they paid or reserved their vehicles in advance, and some short-term debt and other liabilities, 42. Okay, so we have a total of almost $1 billion in liabilities. And similarly with like we did with Tesla, right, if we subtract the current assets, or if we calculate the current ratio, we have so if we take 5.345 divided by 1.047, okay, so 5x. So these guys, because they have so much cash, you know, at least in the short term, you know, Rivian should not run into any financial trouble, because they have lots of cash and they have pretty much you know, 5x their current liabilities in current assets. So no, they shouldn't run into any problems in the short term. Now, if we keep going here, they have on their long-term debt, they have some. This is where it gets interesting, right? They have some convertible notes, okay, almost $3 billion in convertible notes, and some long-term debt here, nothing as well, actually nothing, and long-term leases. So they don't have long-term or non-current portion of long-term debt. Everything they have is in convertible notes, and some other non-current liabilities. So they have a total liabilities of $4.2 billion and total assets of 8.48. Okay, so if we were to calculate the equity now using these figures, right, we subtract 4,201 from 8,488, and we get an equity of $4.287 billion, right? Now, if you see here, actually, if we scroll down and we see the equity here, it's actually not even called a stockholders equity, it's called stockholders deficit. And you can see here that they're not actually, they have a deficit of $3.607 billion. So what's happening here? Why, if we're taking the assets and subtracting the liabilities, why are the shareholders left with actually a negative figure? Well, everything is actually happening right here in this section under this commitment and contingency. So as you can see here, let me read: contingently redeemable convertible preferred stock. So this Rivian had to issue preferred stock, okay? And the thing with this preferred stock is that it can be converted, right? When it says convertible preferred stock, or when you have something like a convertible bond, you can take that bond and or that preferred stock and convert it into common stock or common shares. Now, here it says that not only this preferred stock is convertible, but it is also redeemable. Okay. So it is redeemable, and this is very important here, because what happens is that if they were to actually redeem this preferred stock, Rivian would have to give cash to those preferred stockholders. Okay, so it's pretty much like having a liability, right? And if you are a common stockholder, then and you have all your preferred stockholders wanting to redeem their preferred shares, then that it doesn't matter what happens to the common stockholders, they would take priority. Okay, so yeah, that's why they have here this line item, $7.894 billion worth of redeemable preferred stock. So if we now take that figure, let's go back to our calculator here, and that's the previous equity that we calculated, right, based on just assets and liabilities. If we were to subtract here 7894, then see we get 3607 negative that, or 3.607 billion dollars, and here we have, which is exactly this figure right here. And the last thing I want to mention here is that with what you learned today, you can actually calculate a bunch of ratios using all the elements that you find in the balance sheet. Some of them are things like the price to book ratio, the return on equity, the return on assets, the debt to equity ratio, the current ratio, which we saw, the working capital as well. So I made a bunch of videos on this, so I will leave you the links in the description below. Feel free to check them out. Okay guys, I think this is enough for now. I want to thank you for joining me today. In my next video, which will be the final video in this Introduction to Financial Statement series, we're going to take a look at the third type of financial statements, which is the statement of cash flows. Thanks again for joining, and I'll see you next time. Stay tuned.